welcome back to Extension channel. If you have been checking your stock portfolio this year, most of the time it is showing red, red and red. Quick look at the Standard & Poor's 500 chart. The year-to-date price has dropped from 4,796 to 4,204 as of March 2022 in just 3 months. That's like a 12% drop. Is it a bear market? Well, a bear market happened when the stock price dropped by 20% or more. So it is not a bear yet. If we recall, the market is doing really good for the past 2 years after the dip in March 2020. That is exactly 2 years ago when the lockdown of most countries started because of the pandemic. Then the stock market just keeps going up and up, and there was no double-digit percentage pullback at all. Good for you if you do make some profit in between. Right now, many are predicting that the market will crash in 2022. Or maybe we call it a correction. The market is dropping in the expectation that there will be interest rate hike by the Federal Reserve this year. It is said that the interest rate is likely to increase 5, 6 or 7 times this year. In our previous video, we do mention that too much money has been printed in the past 2 years and it causes inflation.
Now, what US has been doing since 2020, they have been printing a lot of money just to cushion their economy, right? That's why you see the S&P 500, instead of going down, it went up and up in 2020, 2021, and now we are in 2022. Okay, now let's talk about inflation. How inflation affects all of us.
The average historical inflation rate is around 2%, and it is said that the increase in the consumer price index just last year was 6.8% in the United States, which is the highest for the past 40 years. That is why it is very likely that the Fed will increase the interest rate to control the inflation. This will definitely slow down the economic growth rate. High inflation, low purchasing power, high interest rate, low profit margin for businesses, all these are theoretical and will drive the market down when investors are predicting based on the interest rate change. Apart from that, since the start of the year, there are news about the spread of new variant of COVID-19 and the concern about Russia-Ukraine crisis. All these news instill fears in people, causing big sell-off when people feel like holding cash is the safest and the best to do during the uncertain time like this. The sell-off effect mainly comes from the institutional investor like the big asset management companies, which are holding big portion of the shares in the companies. Their sell-off will definitely drive the price down, and people are emotional when seeing the market to drop. Most likely, they also feel uneasy to hold and follow the emotion to sell. The stock price change because of supply and demand. If more people want to buy, there is higher demand, then the price move up and vice versa. It is a reflection of the market sentiment. When investors feel like the stock has great future potential, they will definitely want to buy more now. All these are difficult to predict. If we are just retail investors, we will not know when will be the next steps of the big investors. What will be the next good or bad news of the company or the world? Who knows when will COVID end? To play safe, invest based on fundamental analysis and do not try to time the market. Do not buy or sell emotionally. I know that is super hard. Have a long-term mindset. If you are too concerned about the price movement, do consider invest in dividend stocks. If you are looking to open an online brokerage account with MooMoo, referral link is in the description below. With a deposit of any amount, you will receive a chance to draw for a free stock worth between $9 and $3,500. If you are active in learning and able to complete the task in the task center, you could redeem some gift in the reward club, just like what I did to get this MooMoo cushion. So that's all for this video. Hope you find this helpful. Stay tuned and see you again next week.